Learning how to qualify for a home loan can be super stressful. That's why in this video, I'm gonna show you how to qualify for a loan, how to get pre-approved, and how to go through the entire process without getting taken advantage of or hurting your credit. What's going on, guys? This is Chandler Smith, and over the last 5 years, I've taken out 10 different loans. And I can tell you the first one that I did was absolutely terrifying because I had no idea what went into the process, and I didn't know what I needed to do to make sure that I got approved for that loan. So in this video, I'm gonna go through every single step of the mortgage process, and I'm gonna show you exactly what you need to do to get pre-approved for a loan so that you can get into that first home or property. So if you haven't already, like the video, subscribe to the channel, and let's jump into it so you know what you need to do to get into that first property. Now, with every bank, there are 4 things they're gonna look into. First off, they're gonna check out your credit score. Next, they're gonna look at your job history or your income. Then they're gonna look at your debt to income ratio. And finally, they're gonna look into your bank account to make sure you've got enough money for the down payment. So I'm gonna go through each one of these 4 to show you exactly what you need to get approved for a loan. Now, the first part of this is your credit score. And I know anytime someone hears credit score, they get a little nervous, all right? Your credit score can be a terrifying thing if you don't know what you're doing. But the reality is that it's not that complicated if you understand how it works. And to get approved for a loan, you only need a 580 credit score. And so it's not that hard to get to that point. Now at 620, it's a lot easier to get approved, and there are different benchmarks along the way, where the higher your credit score is, the higher the likelihood of you getting approved for a loan, and the lower your interest rates will be. But if you're just trying to get into a property, you only need that 580 credit score. There are 5 different things that banks look at, and each one of these things is weighted differently. I'm going to break down every one of the 5 things, and I'm gonna show you how important each one of them is to you getting your credit score up. The first aspect that banks look at is your payment history. And this is actually worth 35% of your credit score. So it's huge, it's the biggest one. And all that it is making sure that you're paying your bills on time. Now, if you don't have any credit, then you're not gonna be able to prove that you're paying on time. This is why it's so essential that you have at least 3 lines of credit. So if you don't already, go and get 3 credit cards or a couple credit cards and a loan on your car. Now, I'm sure a lot of you are saying,
Chandler, credit is bad. Why are you telling me to go get it?
Look, credit is what makes the world go round. And I'm not telling you to blow all your credit and let it build up to where you have a ton of debt. Don't do that. Pay off your bills every single month and prove that you can have credit and pay it off consistently, because it's worth 35% of your credit score. The next aspect that they look at is the amount of credit that you already have. And this is actually worth 30% of your credit score. So you need to get at least 3 lines of credit so that you can start building credit. But in those lines, make sure that you're always paying them off every month and that you never use more than 10%. So if you've got a $3,000 line of credit in your credit card, don't use more than $300 every month. Now, there's another benchmark at 30% where you can still gain points if you're staying under 30%, but you're gonna be able to build your credit a lot faster if you're staying under 10%. And I don't mean leave 10% in there every month, all right? Go up to 10% and pay it off at the end of the month. If you do this, you're gonna be blown away at how fast your credit score goes up. On top of that, don't get garbage credit. So many people are going to get their Best Buy card and their Macy card and everywhere else. Don't apply for those cards, all right? Those are crap cards and they don't get you nearly the amount of points. So you need to get tier 1 cards. Now these are cards from the tier 1 banks. So Wells Fargo, Bank of America, Chase, any of these bigger banks, that's where you want to apply for your credit cards because credit looks at those better than it does at garbage cards. The next aspect that they look at is the length of your credit history. And this is actually worth 15% of your credit score. So the way that you build this up is by taking out credit and showing that you can consistently make payments. That's why it's so important for you to get 3 credit cards and for you to get a car loan and to make those payments because every 6 months you're gonna get additional points to your credit score because you've been able to prove that you can make payments for an extended period of time. So don't go take out a car loan and pay it off a month later. That won't do you any good. You need to have consistent payment history for those 6-month and those year-long and those 2 to 3 year long periods to build up this aspect of your credit. Now, the next aspect is the amount of new credit. And this is only worth 10% of your score, but I've seen a lot of people go and totally mess up their score because they don't understand this aspect. So they hear that they need to get credit so they can get a loan on their home. So they go and get 3 credit cards and they take out a loan on their car and then they're applying for a mortgage on their house and they get denied because they've totally jacked up their credit score by going and getting a ton of new credit. New credit is bad on your score. Now, it's a catch-22 because you need new credit to build up longevity of long credit. So you're gonna have to take some of those dips in your credit. But if you're trying to apply for a mortgage tomorrow, don't get any new credit. And when you're shopping out different lenders, whether you're going to credit unions or banks, make sure that you shop them out and you don't let them pull your credit. What you need to do is ask them all the right questions. Find the ones that you think you have the greatest likelihood of getting approved for a loan by looking at all of the other aspects that we're gonna talk about today. And once you find the lender that knows their stuff and that knows you'll get approved with all of the other things they've looked at, as long as your credit score is half decent, then have them be the ones that pull your credit. Because every time you get it pulled, that's affecting your credit score. So if you're shopping out 10 different lenders and they all check your credit, then you could have gotten approved by one of them, but if he's the last one that pulls it and your credit has jumped down 10, 20, 50 points because of all the new credit you've been looking for, then you're not going to get approved. So shop them out first, and then once you're comfortable with one, have them be the one to pull your credit. Finally, the last aspect of your credit score is your credit mix. And this is only worth 10% of your credit score. And again, if you don't have a good mix and you're trying to get a loan on a house, go get the loan on the house. Don't try and get your mix beforehand. But if you're thinking of getting a loan down the road or after you get this loan and you're wanting to build your credit, you need to get a mix of credit. And what that means is that you're getting your 3 credit cards, you're getting a car loan, and you're getting a mortgage. If you have a mix of those 5 things, you're gonna look awesome to the credit companies and everyone else as far as having a good mix, and you're gonna be able to capitalize on that 10% to bump up your credit score. Just remember, even if your credit isn't perfect, you're still going to be able to apply and get approved for a loan. So take advantage of these tips, but don't freak out. Talk to a great lender, and I promise you they're gonna be able to help you get approved as long as you're doing everything else that we talk about right. The next thing that lenders are looking at is your job history. And a lot of people are saying, Chandler, what does that even mean? Well, first off, it means that you have a job and that you can show you've got enough income to pay your mortgage, which we'll talk about later in the debt to income ratio. But the biggest aspect of this is if you're a W-2, you're set because you can show you have a consistent wage that isn't going to be changing. However, if you're on a commission-based job or a 1099, then you've got to show 2 full years of you getting paid a good enough income in this commission job. And sometimes that's a roadblock people run into because they might have a huge income, but they only have 1 year under this commission job. Now, if you're working with a good lender, sometimes they can figure out a loophole to get you through, but that's usually the rule of thumb that they're looking for. Now, the next aspect that banks are looking at is your debt to income ratio. And for some reason, when we hear this, we freak out because we think it's some crazy wild algorithm that they're looking at, but it's really not that complicated. So I'm gonna break it down so you know exactly what to look at to see if you fall into the right debt to income ratio so you can get approved for a loan. The first thing that you need to know is if you're doing an FHA loan, you can have a 55% debt to income ratio or less to be able to get approved. And when it comes to a conventional loan, you only need 50% or less. Now, a lot of people think that when they look into the debt to income ratio, they're looking at insurance, they're looking at utilities, they're looking at groceries. They're not looking into this stuff. They're just looking into car payments, they're looking into your student loans, they're looking into other house payments, or they're looking into any other debt that's actually reported. So to figure out your debt to income ratio, let's do a quick scenario. Let's say that you've got $3,000 in total income coming in every single month. We're going to say that you have a $500 car payment. We're also going to say that on your student loans, to calculate it, you take 1% of the total. So figure out your own student loans, but we're going to say after you do that math, that you have $200 in student loans that's going into that every month. And we're going to say on your credit cards, you've got a minimum payment you need to make. We're gonna say that you have $300. So if you do the math on that, that should put you right at $1,000. That means to get to your 50%, you have $500 more to spend. On your monthly payment or your mortgage payment, you need to be $500 or less. So if you need to change it around because you want a bigger mortgage, then you need to eliminate some of this other debt, or you need to increase your income. But that's what you need to do to figure out right on 50%. Now, you don't want to be dead on 50% if you can help it, because the likelihood of you getting approved goes way up if your debt to income ratio is lower. But for most banks and credit unions, you can get approved if you're at that 50% mark or less. The last aspect that they're looking at is your cash on hand. And all that they want to see is that you've got enough cash to make your down payment, your closing expenses, and still have money in the bank so you don't send yourself into bankruptcy. So as long as you've got that, you're gonna be good. Now you can talk to your mortgage officer to make sure that you've got enough on hand, and they're gonna know where that number's gonna be. But you've also gotta remember, the more money you have in the bank after being able to afford your down payment, the better you look to lenders. So make sure that if you do have the ability to keep more money in the bank, do it so that you can get approved for that loan. And guys, that's it. If you've got all of those aspects, you're going to get approved for a loan. Now, the last tip that I wanted to give you, and this is probably the most helpful hint out of this entire video, and that is find an incredible loan officer. Find someone who has done tons of loans and someone who is willing to get creative for you. Because I can tell you, I've seen people that even match all these requirements, but just barely, but they don't get approved for a loan because they don't have a loan officer that's willing to go to bat and help them manipulate things to make sure that they get approved. So do your research. Go meet with multiple loan officers. Find the guy that's promising you, look, if you can do X, Y, and Z, I'm going to get you approved. If you guys enjoyed the video, push the like button, subscribe to the channel, and comment below. Let me know if there's anything else you want to know to help you get approved for a loan. Because my goal is to help you get into this first property and to help you get into multiple other properties so that you can build yourself a huge passive income. Thanks so much, guys. Have a great day.